a U.S. equity strategist at Citigroup. And Drew, I think I know where you're coming from. We've seen this movie before where things are going pretty good. You mentioned post-pandemic where we had that unbelievable run-up after the sell-off. And then back at some other occasions where stocks get so far ahead of themselves, the earnings continues, there's growth, but it just might not be good enough to prevent some profit taking.
Yeah, I think that's where we are again today, Joe. And the beauty of that is if you have a healthy bull market, you should have profit taking. So we think it's completely fine to enter a more volatile phase of the bull market and for investors to take some profits on good news when it's finally announced, just to give us a healthier setup into year end and to continue the bull market beyond, year 3 where we're at today. So again, taking profits on good news is healthy for a structural bull market.
You said this is similar to that post-pandemic rebound, and then I don't even want to mention the other time you said it was similar to the tech bubble, 1999. We don't want to say that, do we?
I think this gets overblown a little bit. Look, when we go through this on our team, what really ended the tech bubble? Was it valuation or the fact that earnings in these companies were never going to live up to expectations? The difference is fair value today. If you discount what we in the street are seeing for earnings growth, you get to a fair value of about 6,600. When you looked at some of these other places in time, the market, the forward expectations, the sell side, I would say even the buy side wasn't really there. Prices just ran way too far. So I think it's earnings driven now out of profitable companies. As long as we can live up to that expectation, it doesn't have to end the same way. The bubble comparisons really are just made for TV.
Yeah, and your point is that there's certain times where it's all about earnings growth, and it even takes precedence over other things. You call them cyclical factors. And you're not saying earnings growth is necessarily going to disappoint, but it's already in the stocks.
Yeah, exactly. And the interesting thing about this cycle is we have disconnected from GDP. If we had this conversations in the 70s, 80s, even I would say coming out of GFC, it was all about the cyclical. Right now, it's about the structural. The structural is strong, but the structural is priced in. So again, you buy on dips, you sell on strength. That's healthy behavior in a bull market.
So are you buying dips? Is that, if we do get the dips that you're seeing, you're buying and you'd stick with growth, not value, and even the tech side of growth?
Yeah, it's funny. We'd actually pair it. We would buy growth. Large cap growth has really good earnings momentum. Those revisions say strong up and to the right. You buy on any weakness. The other area where we are buying is small cap. And this is the place where it really has been left behind. We're just starting to talk about Russell 2000 all-time highs. This is where we're seeing an inflection out of an earnings growth recession. And the macro catalyst finally to pair with that is the Fed easing. So barbell the portfolio, NASDAQ plus Russell, I think you actually get a pretty good ride in Q4.
The Fed eases. You don't think that the reason for the Fed easing, or what could make it almost a slam dunk, is a slowing economy? I mean, the government's still closed. You didn't even mention that, Drew. I don't think you say anything about tariffs either. We obsess and then we don't obsess.
Yeah, it's funny. The difference between now and when we were obsessing is the One Big Beautiful Bill Act. And that becomes a big offset for tariffs. I know we're working through some concerns right now, but with tailwinds from tax in effect, the earnings growth recession behind us for small cap, so it's already working out of a negative place, forget the macro. As long as we don't go into proper recession, you probably have upside in earnings still in small cap. For the first time in more than 8 quarters, you have real earnings growth. And when you boil it all down, why would anyone buy a small cap stock, let alone the small cap index? Is because you expect growth from those smaller companies. We haven't had that. We finally have that now.